to understand what owner's earnings were and how that number was actually calculated whenever you look at a cash flow statement. And so what we're going to be doing now is we're going to learn how to discount those cash flows over the life cycle of the actual stock that you're interested in potentially buying. So as we scroll down, you can see that we have another intrinsic value calculator here. This one's going to be a little bit different than the intrinsic value calculator that you learned about in course 2, where you were using dividends and book value in order to estimate future cash flows over a 10-year period. This calculator kind of goes a step a little bit further than that, where it not only values the cash flows over the next 10 years, but then it goes and it values the cash flows into perpetuity or forever. So let's go ahead and get started, and let's look at the very first line. And when we look at the first line, you can see it asks a question. What is your company's free cash flow, or also known as the owner's earnings? And this is what we learned about in the very last lesson, lesson 7 in course 3. And so as you saw, you were taking the cash flow from operating activities and you were subtracting out the capital expenditures in order to arrive at what the owner's earnings were. This is also known as, to a lot of people, known as free cash flow. So what you're going to do is you're going to go ahead and estimate what that free cash flow is for the company, and that's going to be your starting point for assessing the value. Something that's different about this intrinsic value calculator versus the one that you learned back in course 2 is this one values the entire business as a whole. Then after you figure out what that value is, you divide by the total number of shares outstanding to come up with the per share intrinsic value. Whereas the calculator that you learned about in course 2, you were already working at a per share level. That has benefits, which I'm going to talk about later at near the end of the video. But for right now, just realize that we're going to be valuing all the cash flow that's flowing through the business as if you owned every single share of the business. So the first thing that we're going to do is we're going to estimate that future cash flow. And I have a tool here over on the right hand side. You can see it's highlighted in blue. It says estimate average free cash flow. So if you click on that, you'll have a little window that pops up and it says please input values for historical free cash flow to determine the average. So what we're going to do is we're going to go back and we're going to try to determine what the owner's earnings or the free cash flow has been over the past 10 years to kind of develop an average, or what we think would be an average, for what the current free cash flow of the business is. So I have a useful tool here that you are able to input any ticker you want. Let's say you wanted to research Walmart and you wanted to see what their free cash flow was. So what we'll do is we'll go ahead and enter the ticker for Walmart, WMT. And you'll click Find. And what you'll see is that your browser opens up a brand new window and it brings you to Morningstar, and it automatically takes you to Walmart, and it brings up 10 years worth of history for all these different data points. Now the reason I'm using Morningstar instead of the MSN Money is because I think Morningstar kind of does a better job at capturing all the past 10 years of data, and it lays it out in a really easy to understand manner here, and it's a little bit better than MSN with that respect. So that's why I have the page automatically linking you to Morningstar. So when you look here, another thing that Morningstar does that's really nice is it automatically calculates that owner's earnings or the free cash flow for you. So if you go down here and you look right here, you can see where it says free cash flow. And underneath of that, it even has free cash flow per share. But like I told you before, we're going to take the free cash flow for the entire business and we're going to go ahead and input that into that calculator that we have on the Buffett's Books website. So if you highlight the free cash flow for the last 10 years and control copy, make sure that you don't capture that last number. That's the temporary or the current number that's happening. Pick the first 10 and not that 11th number off to the far right. So once you have those numbers highlighted, just simply copy those, and then we'll go back to our tab where the discount cash flow model is at for calculating the intrinsic value. And something that I did with the code is if you just hit Control V on that first tab, the numbers will automatically populate for all 10 years, and it will automatically figure out that average free cash flow across those 10 different numbers. So that's kind of useful and makes things a little bit quicker for you so that you don't have to input each and every number. So as we look at these numbers for Walmart, and you can kind of see how they trend, and these numbers are in millions, but it's okay that we round that off, because whenever at the end of this calculation, when we put in the number of shares, we'll round off the numbers so that they're comparing apples to apples. So as we look at how these numbers trend from left to right, you can see that 10 years ago, Walmart had $5.6 billion of free cash flow. The next year it was 2.1, and so on and so forth, the whole way over to our current year, which is just last year, which is -1, which was 12 billion. So this average, and we want to take the average of this owner's earnings, or also known as the free cash flow, because what you'll find is a lot of companies, this free cash flow changes pretty dramatically from year to year, because the company might have a lot of capital expenditures in one year and maybe not in the next. And that's why we're taking 10 years of data to come up with that average. So you can see here that our average for the last 10 years for Walmart is around $8 billion for the entire company. So what we can do is we can just click on this little button that says use this average FCF. And when we do that, it automatically updates that number into our input box. So you don't have to do anything. You just hit that button and it'll automatically populate in there. So next, the next question we're going to ask, so that's our starting point. That's our foundation, that free cash flow. We're going to now take that number and we're going to estimate how much that's going to grow into the future based off of however many years we want to put in there. And then we're going to discount all those cash flows back to today's value. Okay, so our next step is how much do we think that that free cash flow is going to grow over, let's call it the next 10 years. Okay, so if you want to be conservative, you could put maybe 3% in there, and you can put 0.03, or you can put simply 3%, however you want to input it. Okay, so we'll just put 3% in there. And by using 3%, we're essentially saying that we don't think Walmart's going to grow whatsoever. It's not going to grow at all. It's going to all it's going to do is keep up with inflation, because inflation is typically around 2 to 3%. If you think that's too conservative for you, then you can maybe put in a higher number, maybe 5, 7, 10%. Again, I have another tool over here on the right-hand side that's in blue. It says Estimate Average Growth Rate. And so what you can do is you can click on that, and then another window pops up to help you estimate what you think that the free cash flow might grow at. What rate do you think that that's going to grow at? So if you remember, I told you that the free cash flow kind of is high and low and kind of doesn't really represent a stable number because the company has a lot of capital expenditures. But if we use maybe the net income, or maybe like the book value or something like that, that might be more representative of how the company might grow over the next 10 years as we look towards the future. So if you want to look up that number again, you could do it two different ways. You can input the ticker again here and click find, and then it'll bring up the Morningstar page again for you. Or you can just go back to the page that you already have pulled up. And we can look in here and we can take a look at, let's say, the net income. So when we look at Walmart's net income, it was $9 billion 10 years ago. And you can see how that's really showed a lot of stability in that number and how it's grown through the years. And now it's close to $17 billion in 2013. So let's just say on average it went from $9 billion up to $17 billion over a 10-year period. It went from 2004 to 2013. So let's go back to our estimator here. And you can see how it says what was the net income in the past. So the net income was $9 billion, so we're going to represent that by putting in 9,000 because we rounded off all the zeros. And that was in 2004. And then the current, which was in 2013, the number went to approximately $17 billion. Okay, and that was in 2013. Now you can see that the calculator has already calculated what that average growth rate is for the past 10 years. This is what it's done in the past, and it's grown at about 7%, 7.32% annually, okay? So now if you want to use that growth rate as what you think the owner's earnings are going to grow at over the next 10 years, the future 10 years, you can use that by simply clicking on this button, and it'll update the information in the input tab. Okay, so you can see that when we clicked on the button, it updated into 7.32%. Here is our expected growth rate for the owner's earnings. So you can use that number. That's the tools there for you to kind of manipulate the number to figure out what you think is a conservative estimate. If you have numbers that are kind of sporadic, you might want to pick the ones that are the lowest to kind of give you a very conservative estimate of what you think the value of the company is ultimately. So the next input that we have is, what do you consider short term? And what you're going to use for this short term growth rate is that's how long it's going to apply the growth rate that you have above. So if we put in 10 years, what it's going to do is it's going to assume that that free cash flow of $8 billion is going to grow at a 7.32% growth rate over the next 10 years. Okay? And then after that, we're going to use a different growth rate for years beyond 10 so that it's much more conservative. So we'll just use 10 to start this calculation and for demonstration purposes. So we'll use that as 10, and then we'll click continue. So when we do that, what you see is we have a little chart that populates here onto the screen, and you can see how the owner's earnings or the free cash flow is growing by 7.32% each and every year for 10 years into the future. So in 10 years from now, we would estimate that the free cash flow would be around $16 billion, and currently it's $8 billion. Now, the next question that we have here is, what discount rate do you want to use in order to discount these future cash flows? Now, this is a very important number to understand, first of all, and when we see 10%, what that's essentially saying is whenever we're done and we figure out whatever the intrinsic value of this company is, let's say the intrinsic value is $50 a share. If we use a discount rate of 10%, okay, and the company's actually trading on the stock market for $50, we could generally assume that we'd make a 10% annual return based off of that discount rate input. So the thing that you have to understand is if the intrinsic value isn't $50, well then we have to manipulate and play around with that discount rate until our market price and our intrinsic value is equal, and then that discount rate will actually tell you what your expected annual return is. For right now, you'll see that we built something into the calculator later on that helps you solve that very quickly. But for right now, let's just use a generic 10% as what return we'd like to get for owning this particular company. And so you can just leave that input field as 10%, and we'll go to the next step. When we click continue, what happened was each and every year for the next 10 years into the future, we've taken those future cash flows and we've discounted them back to today's value at a 10% rate. Okay, and then you can see that DFCF, that stands for discounted future cash flows. The DF is your discount factor, which is nothing more than the 10% raised to the year's power, if you wanted to figure that out. Okay, but it automatically does that for you. So let's go to the next step, and you can see how it summed up all those future cash flows that have been discounted. And our value is at $70 billion, but that's summed over a 10-year period. Okay, now we're going to look at what happens to this free cash flow or this owner's earnings after the 10-year mark. And this is where this calculator kind of goes to the next step and kind of takes things a little bit further than you learned about the calculator in course 2. Is this calculates literally the free cash flow into perpetuity or forever. Okay, so when we do this, we want to make sure that we use a very conservative number, something that's I wouldn't go anything higher than what you think the estimated inflation rate would be, which is about 2 to 3%. So you could put 3% in there, and what it's going to do is then it's going to grow that $16 billion that you see in the free cash flow in year 10, which you see highlighted there. It's going to estimate that that's going to continue to grow at 3% into infinity, okay? And then it's going to add up all those cash flows, and then it's going to discount it back to today's value. So when you hit continue, what it's going to do is it's going to figure that out for you. And you can see right here where my mouse is at, it says discounted perpetuity cash flow. So for the first 10 years, we had $70.8 billion that were discounted back to today's value. Then when you add in the discounted perpetuity value, that's another $90 billion on top of that. So we've got all that money. It's all summed together. The calculator's doing all that for you. You can do it by hand, but if you want to understand the actual calculation and the numbers behind this, Stig Broderson and myself have this in our new book, which is titled The Warren Buffett Accounting Book. It has all these calculations in here if you really want to understand how to do this stuff, or you can simply use this calculator. And so once we have all those cash flows summed up, the last step that we have to do is we have to figure out how many shares are currently outstanding in the company so we can divide it by all those cash flows and figure out what the intrinsic value is per share. Okay, so in order to find that number, we can go back to our window that we already had opened on Morningstar. And what you're going to do is you're going to go over here to where it says quote, and you'll click there, and it's going to bring up the quote for Walmart. And you can see that when we scroll down, right here it says shares outstanding. And you got 3.2 billion shares outstanding of Walmart. And if you remember, we dropped all the zeros off, so we can just use 3,283 when we put that into our calculator. So I copied those numbers, or I copied that number, and I pasted it into the field here. When I click continue, it's going to automatically figure out our intrinsic value based off of all those inputs. Okay, so right now the intrinsic value per share is $49.22 at a 10% annual discount rate. Okay, so we know when we go back to the Walmart page, what's Walmart currently trading for? Okay, if we go to the top, you can see Walmart's trading for $75.02. Okay, well that's not what our intrinsic value is saying that it is. The intrinsic value is saying that at $50 or $49, we can get a 10% return. So that makes you wonder, well, what kind of return would I get at $75, which is much higher than the intrinsic value that this calculator is saying? So we added a final step in here that doesn't force you to go through a trial and error by adjusting this discount rate up here until it equals the market price. All you've got to do is you input this last field. It says, how much is your company currently trading for on the stock exchange? And that's where we would enter $75.02. So we go 75.02. When we hit calculate, it's going to tell us the discount rate that gives us that market price. Okay, so when we do that and we enter it, it says based on the cash flows you have forecasted and a market price of $75.02, this company may yield 7.76% annually. So there you have it. That's the discount cash flow model for determining the intrinsic value like Warren Buffett would do. Using the owner's earnings that you're calculating off of the cash flow statement. If for whatever reason you don't really understand what the free cash flow is, or we call it owner's earnings, you definitely want to go back and watch the previous video, which is owner's earnings lesson 7, and that goes into detail describing how the owner's earnings is calculated and what that number really represents to you. So let me get into just talking some of the specifics with using this calculator. So one of the things that is really nice about the calculator is if you want to go back and you want to adjust these 10 years, let's say that you wanted to have a more conservative estimate and you didn't want to grow that free cash flow for 10 years at a 7.32% rate, and you wanted to maybe only grow it for 5 years at that rate and then go down to the slower growth rate of 3%. So what you do is you just type in 5, and when you hit calculate, what you'll see is this chart updates for the future 5 years at that 7.32%, and then it immediately goes into the perpetuity growth at 3%, and it recalculates those numbers. And when you do that, you can see how our intrinsic value for a $75 share price got worse. It got lower because the free cash flow was not growing at such a long rate of 7% for 10 years. So this comes in really handy. Let's say that you were looking at a company like Apple maybe 3 or 4 years ago when Apple was extremely hot and it was growing at an enormous rate. And no one could really, everyone knew that it wasn't going to last forever. It was just a matter of how much longer it was going to last. So if you were trying to value a company like Apple maybe 3 or 4 years ago, let's just say that let's just use our free cash flow here as representative of what Apple's might have been, okay? And let's say that Apple was growing at like a 25% growth rate, but you only anticipated that lasting for a couple more years. Let's say you expected that to go maybe another 3 years or 4 years, okay? So what we could do is we could put in 3 years of Apple growing at that growth rate of 25%, which is very high, okay? But it was symbolic of what they were actually growing at the time. So you can put that really high growth rate in. And then what you could do is you could keep a really low growth rate in for after those 3 years for that perpetuity growth rate of maybe 3%. And when you hit calculate, it'll only sum and grow those cash flows for another couple years, and then it'll level it out. And what you'll do is you'll get a much more symbolic representation of what the future cash flows might be for a company like Apple or some type of emerging or growth pick. So it's really beneficial, and this is one of the advantages of using this intrinsic value calculator over the one that you learned about in Course 2, is that if you're trying to value a company that's high growth or something that's growing, that's a great company, doesn't have any debt, has all these other fundamentals, but for whatever reason it's really kind of exploding with its earnings, what you can do is you can adjust this calculator so that it's not summing that large growth rate over the next 10 years and it's just doing it for a short amount of time, and then you have a conservative estimate for everything beyond that into infinity. So another use that this calculator, which I would recommend using this calculator over the one that you learned in course 2, is if you have a company that has a very high amount of share buybacks. So a perfect example of this has been IBM. So in the past 5 years or so, IBM has been buying back a lot of their own stock at an enormous rate. And whenever that happens, from an accounting standpoint, when the company is using their own cash on hand in order to repurchase their outstanding shares, those shares get listed as treasury stock in the equity line of the balance sheet. When that happens, what you'll see is that the company's book value per share won't grow. And that's exactly what we've seen with IBM. Even though the company's had a very large amount of free cash flow and a large amount of earnings, you haven't seen the book value grow at all because of this accounting trick that's actually occurring, and you've seen the book value just remain flat. And so for a lot of people that are trying to value a company like IBM with the intrinsic value calculator that they had in course 2, you'd have a harder time figuring out what the value of that company is without using a calculator like this one. So that's the next example that you might want to prefer this calculator over the one that you have in course 2, is if the company has a large amount and a significant amount of share buybacks occurring within the business. The final advantage that you'll get using this calculator over the one in course 2 is if the company has a stock split that's occurred in its past, and you're trying to use the past performance to represent your future growth rate. With this, you're valuing the entire business as a whole throughout the entire process, and then at the very end you divide out the number of shares. So by doing that, you avoid any misunderstanding of what the company's actually earned in the past due to a stock split. So I hope this video has helped you understand how to conduct a discount cash flow analysis and determine an intrinsic value. So thanks for watching. I really appreciate it, and I hope you enjoy using the discount cash flow intrinsic value calculator.